AM 740 KBOR. You're listening to Accelerated Wealth with Chris Abeyta and Doug Berkey, where you get retirement confidence in an uncertain world. You know, are you investing for retirement? Sure. Yeah, the markets right now, they are near or at all-time highs, but there's also something going on right now. They're in kind of a stall, and they're kind of going sideways. What if you could outperform the market with only a fraction of the risk? Well, in today's show, we're going to meet Gregg Indovina. He is the lead portfolio manager for Accelerated Wealth. We're going to learn how to build reliability into your investment strategies regardless of the market conditions. So whether they're going up, whether they're going down, we're going to talk about how to use the latest technology to create safety nets. And maybe most importantly, how to make money when the market is actually going down. So if your investment strategy depends on risk in the market, today's show is for you. You know, Doug, there are so many people that are out there trying to figure out how to beat the market. You know, every mutual fund is out there trying to beat the market, every money manager. I remember personally back in the year 2000, I was not in the financial industry, but I was very interested in it, and I wanted to figure out how to beat the market for myself. So I actually went to options trading school. I flew somewhere. I went through multiple training classes, read books, remember back in the days of what were they, CDs or DVD or DVRs or no, VHS. Okay, I got this big old stack of VHSs, and I went through hours and hours and hours of training. I learned to trade options, and I learned to do bull call spreads and bear call back ratios, all kinds of things. And there were times I made money, but I lost a lot more money than I actually made. And what I found out was, yeah, I had all the knowledge. I actually loved the learning that I got, but I did not know which way the market was going. And I was constantly putting on trades, constantly having to readjust trades, constantly having to watch the market during the day at work or during lunchtime. And while I'm trying to work a full-time job, and it just didn't work. I found it's almost impossible for me, not being full-time, to manage my money. And I ended up not in a good situation. I ended up trying to trade options back in the year 2000. If you remember when Bush and Gore had their runoff and we didn't know who was going to be president for about 30 days, the market tanked. I was out of the game. I lost everything. And I wonder, you know, how many of our listeners right now, maybe you're out there and maybe you have been managing your own accounts, or maybe you've been trusting someone else to manage your accounts, or maybe you've had an experience where you've lost a lot of money, or you've had somebody managing your accounts and they've lost a lot of money for you, and you wonder, why am I paying these guys to lose money? Well, today we're going to talk about how to really drive and how you can maybe even outperform the market with a fraction of the risk. And it's something that you don't have to do, but it's a strategy and technology that's actually built in. And so we have Gregg Indovina today. I am so excited. He is a good friend. He is the Vice President of Investment Strategies here at Accelerated Wealth, not just here at our Colorado Springs office. He actually lives in Pittsburgh, but he's for our corporate office. And maybe you don't know, we have 22 offices around the country. Colorado Springs here is our headquarters office. This is where we started, but we're stretching across the nation. A little more about Gregg. He was introduced to the financial markets early in his career while helping an internet company go through the process of going public back in the early 2000s. He was previously an advisor at Merrill Lynch, so we'll talk about his background at Merrill Lynch. And in 2007, Gregg founded the Wealth Point Group. He's also a sought-after instructor for international trading and investment education. He has a company. As a company, he's taught over 7,000 students worldwide on trading strategy. He and his wife, they also reside in Pittsburgh, Pennsylvania with their 2 children. So, Gregg, it's great having you here. Thank you for joining us today.
Oh, thanks for having me, Chris. It's a pleasure.
Hey, tell us about Merrill Lynch. You were there. What was that like when you were actually an advisor for Merrill Lynch?
I originally went to Merrill Lynch because I thought that as I got into the financial services industry, that would be the best place to learn how to best serve my clients and how to plan investments and make sure that my clients would be able to reach their goals. And it didn't take long for me to figure out that was not the game that I had signed up for, unfortunately. It was a massive sales machine. It was all about the company reaching their goals, not necessarily the clients reaching their goals. And I became disillusioned. And I think I may have told you this story in the past, that when it really, there were 2 things that happened to me that crystallized my decision to actually leave Merrill Lynch. One was I was doing a speech to a bunch of women, and after the talk, a woman came up to me and shared her story with me and wanted me to help her out, and she shared that she didn't have any real money, but she needed help with budgeting and things like that. And I said, sure, I'll help you out. When I went back to the office, my manager was not thrilled that I was going to spend time helping somebody that really wasn't going to generate any revenue for the company. I helped her anyway, and it turns out that she was about to receive a large settlement on a fen-phen lawsuit. So it worked out both ways. But that was really frustrating for me to just kind of see that, sometimes when you do the right thing, everybody gets taken care of. And Merrill Lynch was just all about the numbers, and that was really frustrating for me.
If you just joined us today, what if you could outperform the market by taking a fraction of the risk? We're talking to Gregg Indovina. He's the VP of Investment Strategies here at Accelerated Wealth. So, Greg, that must have been, you said, disillusioning working for Merrill. What were some of the biggest philosophy challenges that you felt from a large company that everybody knows about, and here you are trying to help your clients?
The philosophical difference, the main thing was that my job was not to manage their financial situation. My job was to manage them. In other words, we took the position that we have no control over what the market's going to do, Mr. and Mrs. Client, so we're going to put you into the strategy and we're going to walk away. And so our job is really just to keep you in the game. And then I started questioning the reason why. Well, why aren't we taking any kind of action? We take action in every other part of our life, but when it comes to investing, apparently we're not supposed to. Managing the client, was that really in their best interest? And it turned out, no, it was in the best interest of the firm and the fees, because if we could keep people in the game, then that would keep the commissions and the fees turning over. That discovery there made it even harder for me to continue doing what I was doing. And when it really all came crashing down for me is when a new client of mine, I was actually out in Las Vegas, was unhappy with the first 3 or 4 months of his performance in a mutual fund portfolio designed by Merrill Lynch. And he asked me a question that changed my professional life. He said, Greg, what do you do with your money? And I had to be honest with him, and I said, I don't do this, Bill. I just don't. And
you mean you don't do what you were doing for him? You don't do what Merrill Lynch taught you?
Correct, because at that time I'd begin to explore alternative ways to get good returns in the markets and also reduce risk. He said, show me what you do. And I showed him, and he was impressed. And he said, you either do this for me or we're not going to work together anymore. And he said something that changed my life. He said, Greg, you can't go around all day selling Pepsi-Cola and then go home and drink Coke. And I said, wow, I'm just not being true to myself. And that was the end of my relationship with Merrill Lynch.
Wow. So tell me, how did you figure out ways to actually make more money for yourself that was different than what Merrill Lynch was telling you to do for your clients?
Yeah, it took a lot of self-study. You can't go to college to learn these things. You certainly can't learn these things at a large brokerage firm like I was in. It took a lot of self-study and research to find out how the big institutions actually operate, how the big hedge funds operate. And I just discovered a completely different world, a world that most investors just have no idea even exists. And that's the world of quantitative investing. So instead of being in the world of fundamental investing where you're trying to predict markets based upon outside events, the world of quantitative investing takes a different view. It says, we're going to listen to what the markets are telling us, and we're going to react and respond to that. And that discovery changed my professional career and has helped a lot of my clients over the years as well.
So we're going to dive into that strategy. I want to really talk about that. But what I found very interesting about your situation is the philosophy that Merrill Lynch had towards you. You said your job was to manage the client, that you would work with them, you'd put them into a strategy. You had no control over what the market was going to do. And then you're supposed to walk away. And the whole goal for you as an advisor was to manage the client and just simply keep them in the game.
Right, and I'm sure all of our listeners have heard the things such as, we're investing for the long term, right? Markets go up, markets go down, but over the long run, they all go up. I mean, I know all these things because I was taught to say these.
What were you taught to say? What were some of the things that
well, those two right there. We don't have any control over the markets. Markets go up, markets go down. We're in it for the long run. Over the long run, markets always go up. Those are the types of things. And if you try to time the market, you certainly can't time the market. And if you miss the best days in the market, all those things that you hear, and upon further study, they're just not true. Markets don't always go up. certainly not within the time frame that you need them to go up. If you're retiring in the year 2002, markets did not go up all the way up into your retirement, as an example. So all those things, they're all academic type of things, but they're not real world.
Yeah.
And what I was interested in,
you know what, Greg, we're going to
come. What are the real world things that can help clients?
Let's come back. When we come back, we're going to dive into the real world things. If you're interested in learning more about this, we've got workshops coming up this week where you can learn more of what Greg is talking about to secure and strengthen your retirement strategy. And really, how is it possible for you to outperform the market with a fraction of the risk? We've got workshops the 21st and the 22nd of this week. Call 466-5634 to reserve your spot. Space is limited. 466-5634. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Welcome back. You're on AM 740 KBOR. You're listening to Accelerated Wealth, where you get retirement confidence in an uncertain world. I'm Chris Abeyta, your host, with Doug Berkey, co-host. Today we're talking to Gregg Indovina. He is the lead portfolio manager for us corporately here at Accelerated Wealth. We're talking, how do you accelerate your wealth? And what if you could outperform the market at a fraction of the risk? Would you want to know that? That's what we're talking about today.
So, Greg, question for you. How important is it to outperform the market?
Yeah, hey, Doug, how are you? Outperforming the market, there's such a huge focus on whether or not somebody is outperforming the market. And I would ask a client or you the question back is, what if you outperform the market and as an investor and you don't reach the goals that you wanted to reach? Does outperforming the market do you any good? And the answer obviously is no. So what I always try to think about when I implement strategies for investments is, how can we put together a strategy that's going to allow a client to reach the most important benchmark, and that is that they can live the life of their dreams. They can live the life that they want for themselves and their families and onward. So, the whole concept of my portfolio beat the S&P 500 or didn't beat the S&P 500, that's fine. I think that's one way to measure, but ultimately it's really about, are you getting from point A to point B in the least volatile way? In other words, another way to look at it is the problem with most strategies that do invest similarly to the U.S. stock market is the main reason that clients don't reach their goals is not necessarily that the market doesn't give them the performance. It's that the market gives so much volatility and so much heartache and so many emotions of up and down that investors just quit. They give up at the exact wrong time. And so we always want to build portfolios that get us the performance needed, but do it in a way that allows the client to stay confident and stay in the game over the longer term.
Tell me about some of your strategies that you use to do that, because you're talking about what's different than what you did at Merrill Lynch, where Merrill Lynch, it was just, let's put you into a, quote, diversified portfolio of stocks, bonds, mutual funds. You have no control of the market. How is what you're talking about different?
Well, we approach the market first and foremost from the standpoint of risk. We never, at first, in building a strategy, say, well, what kind of performance can we get? The first and foremost thing, and it's in perfect alignment with everything that we do at Accelerated Wealth, is all about managing risk. And what's interesting, if you study the math of investing, is that over time, over multiple market cycles, your final performance is really not determined by how much you make when the market's going up. It's really determined by how much you don't lose when the market's going down.
Wow.
So we always start with, what are some things that we can do to mitigate risk in the portfolio? And your next question would be, well, what do you do to do that, right, Greg?
Exactly. Real quick.
Yeah.
We're talking to Gregg Indovina. He's the VP of Investment Strategies here at Accelerated Wealth. Greg, real quick, you're actually going to be in town the 30th, and you're going to be walking people through what your strategies are. And so we do have limited seating for that. If you're listening right now, you'd like to meet Gregg in person, you'd like to actually get more information than we can actually share on the show about how Gregg mitigates risk, manages risk, and, the opportunity to, I know we talk about outperforming the market, but over long term, outperforming the market, but really at a fraction of the risk. That is going to be April 30th. It's just a workshop where Gregg's going to be speaking. If you're interested in that, you can give us a call to reserve your spot. This, Gregg, is for portfolios of $200,000 or more. And so the number is 466-5634, 466-5634, and Gregg's going to be walking through what we're talking about today about how to mitigate risk and still get strong returns in your portfolio. So, Gregg, how do you do that? How do you mitigate the risk compared to a mutual fund approach or a stock bond buy and hold type of approach?
Yeah, let's talk about this through the use of an analogy. I was one of my recent trips over the summer out to Colorado. Surprisingly, there were tornadoes in the area, which I didn't really know that there were a lot of tornadoes in there. Apparently, you do have those. So let's say that we're all sitting out on your back deck, Chris or Doug, and we're trying to make a prediction about a tornado. Well, how good are we as non-meteorologists in predicting when and how severe a tornado might be?
Not
good at all, right?
No.
Not good at all. So we would be thinking, well, I think one's coming today, and we would be running into the basement. And it would continue to be sunny, and the kids would be complaining, why are we inside when it's so nice out? Well, that's kind of the whole approach of trying to predict what the markets are going to do in the future, and that's just a game that can't be won, in my opinion. So how would we do it? Well, we would look for all of the things that would potentially lead to a tornado. So what are some of the things, guys, that would tell you that maybe it's getting a little bit risky? What would you look for in the sky?
When I was in Oklahoma, when the sky turned green, when the gray clouds went green and got eerily calm outside.
Yeah. Okay, so that would be one thing to look at. What about if the temperature drops 20 degrees in 20 minutes?
Yeah.
That would be one thing. What about when the clouds begin to rotate really, really slowly? Not a big funnel cloud, but just rotate a little bit.
Okay.
Well, those are the things that you would determine that those are the things, those are not a tornado, but those are certainly things that we know as laymen of what things that precede a tornado.
Right.
So the same thing with the market. There are certain things that happen in a market that don't guarantee that the market's going to crash, but boy, it gives you enough information to say, I think it's time to move inside into the basement and move to safety. And we do the same thing with our portfolios. There's certain signature things that happen in the markets, and we put them into indicators, and it's all mathematical and fancy, but the reality is it's just measuring the internal health of the markets, and when those indicators flip a certain way, it's time to move our valued assets somewhere safe. Whether it's to cash or whether it's to bonds or whether it's to a commodity, gold, for example, or maybe we make money as the market falls. So those are the things that we kind of look for, and those are the reactions that we take. Now, remember, we're not predicting when the tornado is actually going to happen. We are actually observing the tornado beginning to happen, and that's when we move to safety.
That's a big, big difference. Now, how is this different from a mutual fund? Because we've got a lot of listeners right now. They're listening, and they're thinking, well, I'm in a mutual fund, and that's the job of my mutual fund manager. I went to a certain store that sells mutual funds. I'm in those, and my mutual fund manager is supposed to watch for tornadoes. Can he get me into cash if he needs to, or into a safe place if he sees those signs?
Yeah, a mutual fund manager, to continue with our analogy, is, all right, we're all sitting on the swing in the backyard, and I know there's a tornado a mile away. We can see it. We can see the destruction. But look way out on the horizon. There's some sunshine. So we're just going to stay outside because eventually it'll be sunny again.
Well, what if the tornado hits? Doesn't the mutual fund manager?
It does.
Oh, it does?
It does, because here's the problem with mutual fund managers. One of the dirty little secrets is that they are actually chained to the swing set outside. They cannot go inside.
Why is that?
Well, because the mutual funds find it very uncomfortable to charge a fee for not being invested in the market. So 90% of the money in a mutual fund has to be invested in the market. And I'm talking about a traditional stock-based mutual fund, which is most of them. They can only play offense. They're not allowed to play defense. So imagine that. You're paying somebody. And recent studies from Fortune magazine have shown that the average mutual fund cost, all the costs added in, not just what they tell you, is well over 3%. And
really?
You're paying somebody to play offense in a world, in an economic and market world that we currently live in. It makes no sense to me.
3%. Wow. And so if you're in a mutual fund, that manager cannot take you to cash if he sees the tornado or the market crash coming.
No.
He has to stay where he is.
All he can do is focus on the long term. they're really counting on you to move in and out of the mutual fund. And I would say, why am I paying you if I have to be the one to move in and out of your investment?
You're listening right now to Accelerated Wealth with Gregg Indovina. He's the VP of Investment Strategies. And maybe you're in a mutual fund-based approach or based strategy for your retirement. And you remember what happened back in 2008 when that tornado hit. You lost 30, 40, 50% of your entire life savings. If you're still in a mutual fund approach or in your 401ks as well, if that tornado hits, you're going to lose money again. If you want to see something different, something that works better, come to one of our workshops. There's possibilities that you can do some completely different, and we're continuing to talk about that. Our workshops are this Tuesday and Wednesday, right? April 21st and 22nd. We're going to show you how to escape the mutual fund trap and actually build a retirement strategy you can be really confident in, that one's going to protect you from a market crash, but also give you the hope and the foresight of what your retirement safety and security and protection is going to look like. The number's 466-5634. We do have limited seating. We've had a lot of people come in. 466-5634 to reserve your spot this Wednesday, Tuesday and Wednesday, the 21st and the 22nd here at Accelerated Wealth. Gregg, I want to get into some of the things that you do, and we're gonna hold you through, okay, to the next, and I want you to continue to join with us. But when we come back, I want to talk about what you did in 2008 that was different than the mutual funds. What happened in your management and the funds that you were managing, or the strategy you were managing? What did you see in 2008, and what were your results? You're listening to Accelerated Wealth with Chris Abeyta and Doug Berkey. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Hey, welcome back to Accelerated Wealth. You're listening to Chris Abeyta and Doug Berkey. We're interviewing today Gregg Indovina, the VP, Vice President of Investment Strategies, also the lead portfolio manager for the active accounts and actively managed accounts that we do here at Accelerated Wealth. Now, Gregg, right before the break, we were talking about the danger of mutual funds and the danger of buy and hold, and why a mutual fund manager, when he sees a crash or a 2008 coming, they cannot actually go to cash and protect your accounts or protect your portfolio because they're locked in. 90% of what they have has to stay invested in whatever that mutual fund is focused on or invested, whether it's large cap, small cap, or a blend. Tell me what you did differently. What did you do in 2008 different than the average mutual fund manager? Because you're not a mutual fund manager, correct?
Correct. No. We implement these strategies individually for each of our clients. And in a word, what we do different is we'll play defense. There's a time to be fully participating in the U.S. stock market, international stock markets, and there's certainly times where it does not make sense to be there. And so your assets need to move to other areas, and even if it's into cash and a portion of it goes into cash, that's fine. So yeah, that, simply put, all we did was we played defense according to all of our rules. This is all rule-based, by the way, guys. This is not, me and the portfolio team sitting down and thinking, well, what's really going to happen here? It's all algorithms and math, and when the signals say it's no longer safe to be in equities and stocks, we begin shifting assets to other areas that are better suited during these storms. And as I mentioned before the break, we can move to cash. We can move to other asset classes like bonds. We can move to commodities such as gold or oil. And if you think about in 2008, what actually went up? Right, what went up in 2008? Well, bonds did fine in certain parts of 2008.
Now, bonds, but not bond mutual funds, am I right?
Depends.
Okay.
Depends which ones you're in, yeah. What else did well? Later in the crash, gold did very, very well. Not at the beginning of the 2008, 2009, but late 2008, gold turned up, so that was an area to allocate money to. And what if there was an investment that actually made money as the market fell? Well, there are those such things, and part of our portfolio was making money as the market went down, and that's a completely unique concept.
You're saying that while the market was going down, your portfolio was making money?
A portion of it, yes.
So for that year, 2008, Greg, what kind of returns were your folks looking at? What kind of performance?
Remember, first and foremost, the idea during these bad market conditions is to preserve capital, so that when the markets do turn back up, you're not starting from a hole. Think about it. If you only lose 10%, you only need 11% to get back to break even. If you lose 20%, you need to make 25%. If you lose 50%, you need to make 100%. So first and foremost, it's to preserve assets during those type of environments. But to make high single digits returns during that type of environment is not unheard of using the strategies that we have.
So what I hear you saying, and I know there's only so many things you can say over the air for compliance reasons, but the average investor lost, and I know the S&P lost about 37% by the end of 2008.
Well, it lost 55% from peak to valley.
55% from 2000, wow, half of everything. And yet you're saying the portfolio, I hear you saying, the portfolio you were managing didn't lose anything. It was actually positive into the high single digits.
Yes.
Wow. Okay.
There's nothing magical about it. It's just being prudent. And,
yes. You're listening right now and you're going, my goodness, I wish so much that in 2008 I didn't lose 30, 40, or 50%, that I actually made 8, 9, maybe even 10%. If that's you and you're still in a situation where when the next 2008 crash comes, here's a question for you. Are you going to lose 30, 40, or 50%, or is it possible that you're in a strategy that could make you money when the market is going down? If you're not, if you don't have this as part of your portfolio, wouldn't you want to have it? Would you like to find out more about it? Give us a call. The number's 466-5634. You can also always email us right here at Accelerated Wealth, right here at the station at money@kvor.com. That's money@kvor.com. Now, we have workshops coming up where we're going to discuss these strategies this week. So Tuesday, April 21st, and Wednesday, April 22nd. We do have limited seating, but you're going to learn how these strategies work and how we protect your retirement. Again, the number is 466-5634 to reserve your spot. That's 466-5634, or email us at money@kvor.com. Also, Greg is going to be in town and actually do an extended presentation on how these strategies work. And, what if you could outperform the market at a fraction of the risk, or when the market's going down, you could actually be making money? Do you want to learn how he does that? Come. That's April 30th. You got a call to reserve your spot. That's not a dinner workshop. It's just an educational workshop. Again, give us a call, 466-5634, if you want to meet with Gregg and Indovina, 466-5634. Greg, I know that in your strategies you have multiple portfolios that you manage, and you want to talk about that platform a little bit?
Yeah. One of the core beliefs that I learned in my self-study and trying to figure out better approaches for money management for clients was that no matter how good your strategy is, it's always going to have periods where it doesn't do so great. What I've always tried to do is to have multiple portfolios that are non-correlated, which means they're built using different inputs, and the results are slightly different in terms of when they go up and when they go down.
And non-correlated means that they don't move together necessarily.
Right. When one is zigging, the other one might be zagging, but they all go up over time. They just do it. They just take a different path. And so one of the ways to still get good performance and reduce the volatility is by blending multiple non-correlated strategies together. So just imagine a bunch of lines on a chart going from lower left to upper right, and they're all squiggling up and down with a lot of volatility, but if you blended all of those together, the line would still go from the lower left to the upper right, but it would do it in a much smoother fashion. And so that's a key thing in how we build our portfolios, is that there are multiple portfolios that are blended together in optimal ways to get the best of both worlds.
Tell me about, you've got something called the lock portfolios, like lock 10, lock 15. Explain how that works. So they're called the MVP, Market Value Protector, because you're always talking about protection, yet I know that you're managing the money and all the money is actually in the market. So this is very different from a mutual fund. Tell me what that lock, let's say, for instance, the lock 15, when you're managing that, the MVP the Market Value Protector portfolio, the Lock 15. What does that mean?
Yeah, there's Lock 10 and Lock 15 are the names of the portfolios, and the reason is we're trying to determine what is the best path for each individual client in terms of the amount of volatility they can handle throughout their investment career. So, for example, a Market Lock 10 or a Market Lock 15, the 10 or the 15 indicates what we believe the worst drawdown will be. And drawdown is the peak value of your account to the lowest value, right? So if you have $100,000 and it goes down to $80,000 before going back up, that's a drawdown of 20%. We try to limit our drawdowns from, Market Lock 10 would be to 10%, Market Lock 15 would be 15%. And those are generous because the historical drawdowns in those portfolios are actually less. We're just trying to give it a little breathing room in the future. And what's interesting about those numbers, let's say that somebody says, well, losing 10 or 15% in a portfolio seems like a lot. I'm just going to move into something safe. Well, if you just invest in a broadly diversified bond portfolio over the last 15 years, you're going to see drawdowns in excess of 10% and closer to 15% just with that quote-unquote safe strategy. And that's with interest rates falling. So when interest rates start to go up here at some point, you're going to see drawdowns. And historically, bond markets have fallen up to 70% at times.
Wow. Okay.
So the market lock concept is just about helping clients figure out where they're most comfortable in terms of risk.
Now, we just got a minute left here, but my understanding is I've never seen a mutual fund with a, quote, a lock or an intentional, hey, here's a safety reserve that you're going to have. So this is very different than a mutual fund where you're tied 90% to stay invested, whereas here you're actually managing the portfolio so that it should never go down more, let's say the Lock 10, it should never go down more than 10% from a peak to a valley. So
right,
that you're
applying the rules that we've been applying with our strategies, and once again it's quantitative, that historically it's never done that, and we would hope, and we've given a little bit of buffer. And there's no certainly guarantee that will not happen, but we're setting an expectation.
Great. And
remember,
we got to jump out here, but what that does is it gives you as the investor, if you're listening, the security to be able to sleep at night knowing that somebody's watching over your money and they're managing it with some certain rules to really do their best to make sure your account value is never going to drop, hopefully more than 10 or 15% based on which you look at. If you want to learn more about that, just stay tuned. We're going to jump back in here. The number's 466-5634 to come to one of our workshops on the 21st or the 22nd, or come meet Gregg in person on the 30th and go through these investment strategies. It does require a $200,000 for the 30th only, $200,000 or more in one account to be able to look at these accounts. You're listening to Accelerated Wealth with Gregg Indovina today. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Hey, welcome back. You're listening to Chris Abeyta and Doug Berkey on the Accelerated Wealth Show, where you get retirement confidence in an uncertain world. We've been talking to Gregg Indovina. He is the lead portfolio manager for us here at Accelerated Wealth. And the strategies we're talking about, you cannot get anywhere else. These are not mutual fund strategies. These are not buy and hold strategies for your investment portfolio. They are specific strategies that are only found here at Accelerated Wealth. Now, Gregg, we were talking over the break about, the mutual fund is gone. It is a dead era, and yet so many people are still using mutual funds. We were talking about buy and hold is a dead strategy, and yet we find so many people still stuck in those strategies. Can you tell us about why those are outdated and dead strategies?
It's just because the nature of the markets over the last 15 years, since 2000, I would say that buy and hold is not a good strategy for people. In the 80s and the 90s, except for a couple of little blips, the market just went straight up. And mutual funds, that was their heyday. That's when everybody jumped on board. That's when 401ks were introduced, in the 80s, and everybody just started shoveling money every other week from their paycheck into mutual funds, and the market just went up and up and up and up until it just got so overvalued that it burst. And ever since then, from 2000 forward, that buy and hold strategy via mutual funds is not serving people very well at all.
But we're hearing people right now, the market is it's pushing all-time highs. The Dow's near 18,000. If you got back into the market in 2009. You're doing fantastic. Your mutual funds are doing well. So how can you argue that buy and hold or mutual funds are dead, because it's worked pretty well for the last 6 years?
Well, first of all, nobody got back in 2009 because they were so freaked out over what happened in 2008 and early 2009 that psychologically they stayed away from the hot stove for a couple of years or more.
We still talk to people today that come in and say, somebody we met with just this week that said, I got in 2008, I was devastated, I haven't got back in since.
Yeah, and that's, besides losing money with these strategies, with the buy and hold approach, emotionally it causes people to put more money in at the highs, kind of like where we are right now, and start taking money out at the low. So think about that. Selling high and buying high and selling low. What were you
trained to say, though, at Merrill Lynch when you were a Merrill Lynch advisor? Because you were selling mutual funds. What were you trained to say?
Well, it's just that over time the markets always go up, which is not true, and you cannot time the market, which is somewhat true, but it doesn't mean you can't reduce your risk. And so
just stay in,
keep them in.
My favorite is when the market's down. Oh, it's a fire sale. Everything's on sale. You need to be buying more. Were you taught that one as well?
Oh, yeah. Yeah, when tuna fish is on sale, you buy more of it. Well, not when tuna fish continues to go down in price.
Okay, so buy and hold. Here's the thing that concerns us the most, and maybe you're listening right now and you do have a mutual fund strategy, or maybe it's not a strategy. You just own a bunch of mutual funds in your IRAs, your 401ks, your investments, and you're getting closer to retirement. What happens if you go through another 2008? Or what if you're already retired and you start to spend money out of your mutual funds, and while you're spending, they drop 20, 30, or 40%? Greg, that's what gets me as to why, we have the entire baby boomer generation. 10,000 a day are turning 65. They're getting ready to retire. They're moving into retirement. And yet so much of them, 80, 90% of their entire life savings at risk in mutual funds. I mean, I feel like we're watching the tornadoes getting ready to come, and we're getting ready to watch a devastating financial cataclysmic event here in people's retirements and financial security.
Yeah, the disconnect is people think that if they have a mutual fund that it's being actively managed, and the reality is it is not. They are constantly trying to select the best stocks to own at any given time, but they will always own stocks, as an example, and so when stocks as a whole go down, they all go down. It doesn't matter if you own the best stock or the worst stock. In a bear market, in a bad stock market environment, they all go down. And here's the other kind of thing that's a bit sad. We talk about with our portfolios that we try to define what the drawdown, the potential loss in the future is. Whereas in 2008, there were mutual fund managers that lost, say, 30, 40% of their clients' money, and these mutual funds have hundreds of billions of dollars. So they lose 30 or 40% of that money, and they get a big bonus, and they get accolades because they lost less than the S&P 500.
Oh, that doesn't make me feel good. But we've had people come into our office and we'll say, what happened to 2008? And they're, my guy did pretty good. I mean, the market was down 40%. I only lost 25.
Yeah.
What do you say to that, Greg?
Yeah, it's the measure should not be relative performance versus some arbitrary index.
Yeah.
The measure should be, am I closer or am I still on track to reaching my goals, my financial and life goals?
Huge.
And that's
huge.
That's the biggest issue. Another point I wanted to make.
Hold on one sec. If we're listening, we're talking to Gregg Indovina. We're talking about, what if you could outperform the market with a fraction of the risk? What if you knew that somebody was watching your portfolio investments, and when the market starts to go down, you could actually make money while your peers and your friends at work are losing money? You're actually making money, which is going to help you get closer or reach your goals in retirement or keep you in retirement. If you're interested in learning more about that, come to one of our workshops. We do have those this week, and we do have limited seating. That's Tuesday, April 21st, and Wednesday, April 22nd. The number to call is 466-5634. That's 466-5634 to reserve your spot. Pick up the phone right now and join us. Look forward to meeting you. Also, we have an event coming up where you can actually meet Gregg in person. It's the end of this month, April 30th. You can come and actually visit, talk to Gregg. He's going to be talking about the strategies. Now, Gregg, let's talk about why should they be in your portfolio instead of a mutual fund? What is the best of what you do to manage money?
The main reason is getting away from investment performance, getting back to what's truly important, and that is achieving what's important to you in your life.
Yeah, but I want return. I want to make money. I mean, that's nice to say.
Sure. No, returns are the means to an end, is what I'm saying.
Okay.
And so if you want or you need returns in order to live the life that you want and deserve, then yes, this is a better approach. And the main reason is that we play offense, and we've been playing offense in the portfolios for most of the last 6 years, and certainly here just recently. But there will always be times where you need somebody to play defense on your behalf. And there's just very few places out there that that you can get access to these types of strategies.
So if somebody wants to come and learn more about your strategies, I understand there's a minimum portfolio size to get in. Tell me what that is and why.
Yeah, these portfolios make sense for portfolios that are over $200,000, and the reason is simply that I spoke a little bit earlier about how we run multiple strategies within these portfolios, and there needs to be a certain amount of money to be spread out over those multiple strategies for it to work effectively. Okay,
so you have to have some sort of economy of scale. You can't just come in with a small amount and hope that you can dice it up the way that you need to dice it up and to manage it.
Yeah, there needs to be a certain amount of assets to be allocated for all the strategies to work together as we design them, yeah.
Gregg, we talk a lot about with our clients how to not run out of money in retirement. And one of the biggest things that we find is people are taking way too much risk when they walk into our, and a lot of reasons, that's why they come into our office, why they sit down with Doug, why they sit down with me or both of us, is they know that something is wrong. And they know that the plan that they have, they are not 100% confident that it is going to get them to where they want to be in retirement. If you're listening right now, let me ask you that question. Are you 100% confident? So on a scale of 1 to 10, 1 being not at all, 10 being I am 100% confident that your plan is actually going to get you where you want to be in retirement. Is it going to provide the security and the lifestyle that you want in retirement? If you can't answer yes to that 100%, you probably don't have the right plan and you need to do something different about it. Give us a call, or you can email us right here at the station, money@kvor.com. That's money@kvor.com. If you want a portfolio review to find out why you feel that way, you can call us at 466-5634. That's 466-5634. But Gregg, I find just in the last minute that we have here, people have so much risk in their portfolio, and a lot of times it's because they've been misled. They've been told, hey, my guy has me diversified. I've got lots of different types of stocks, bonds, mutual funds. In fact, I've got an IRA over here, a 401k over here. What we've seen, that diversification doesn't work. How? Tell us why your portfolio.
Diversification works fine when markets are going up because everything's going up, and they're going up at different rates. The problem becomes in a bear market, everything becomes highly correlated. In other words, they all go down at about the same amount. And the problem right now with risk is people are more comfortable with the risk that they have because the market's been going up for so long. They've lost touch with the actual risk that they're taking. And unfortunately, Noah built his ark before the rain, and that's what we need to do. You know what?
You might be right there right now. You may be really comfortable because the market has been going up, up, up. But you need to find out, do you have safety measures built in, and are you confident that when the next 2008 comes, you can actually make money instead of lose lots of money when the market is going down? Give us a call, 466-5634. Email us right here, money@kvor.com. Gregg, thanks for joining us today. Doug, thank you. Jay, thanks for mixing the show. And Mickey, Thank you for joining us in studio as well. You've been listening to the Accelerated Wealth Show, where you get retirement confidence in an uncertain world.
The opinions on this radio talk show are those of Mr. Abeyta, Mr. Walton, and their guest speakers, not necessarily those of Accelerated Wealth, LLC. The radio talk show may contain forward-looking statements, including but not limited to statements as to future events that involve various risks and uncertainties. Forward-looking statements involve known and unknown risks, uncertainties, and other factors that may cause actual events or results to differ materially than those that were forecast. Therefore, no forecast should be construed as a guarantee. Investing in security and annuities involves a risk of principal loss. Prior to making any investment decision, a listener should consult a professional to determine the risk, benefits, fees associated with a particular investment. Info obtained by a third-party resource is considered reliable, but accuracy cannot be guaranteed.